With mortgage rates currently more than double compared to 2020 and 2021 and high home prices, the house market is struggling. We're seeing the lowest number of existing home sales since 2010's foreclosure crisis, and mortgage demand is at its lowest in over 20 years. Given all this, it's worth asking, could the housing market be heading for a crash, and even worse than 2008? Let's find out. Warning signs that could dampen the housing market. Today, the current average interest rate for the benchmark 30-year fixed mortgage is 7.02%, and the national interest rate for a 30-year fixed refinance is 7.15%. Meanwhile, the current average 15-year refinance interest rate is 6.37%. This is the highest mortgage rate since the early 2000s, combined with record low affordability, are pushing many potential buyers out of the market. Some are priced out, while others are hesitant to buy due to fears of future declines in home prices. Additionally, many homeowners who purchased their homes in the last 2 years and secured ultra-low mortgage rates will likely stay put. This reluctance to move contributes to the ongoing strain on housing inventory. A significant factor in the rising mortgage interest rates is the Federal Reserve's efforts to control inflation, which surged in 2021 and reached a 40-year high of over 9% in June 2022. To combat this, federal policymakers have increased the federal funds rate, impacting mortgage rates 11 times since March 2022. This is the most aggressive rate hiking pace since the 1980s. Though there has been a pause in rate hikes in the past 2 meetings, leading to speculation that the increase might be over, high rates are expected to continue in the near term. Dr. Lisa Sturtevant, chief economist at Bright MLS, mentions that the Fed, committed to achieving 2% inflation rate, has signaled no immediate interest rate cuts. Adding to this, Fed Chairman Jerome Powell has stated that if the current policy doesn't significantly reduce inflation to a sustainable 2% rate, policymakers won't hesitate to increase rates again. This statement indicates a continued focus on controlling inflation, even if it means sustaining higher mortgage rates for a while longer. What would a recession mean for the housing market? A recession, as defined by the National Bureau of Economic Research (NBER), is a period of several months marked by a significant downturn in economic activity. To spot one, economists look for certain indicators: a decline in GDP in 2 consecutive quarters, rising inflation and borrowing costs that curb spending, a slowdown in manufacturing and trade, increasing job losses and unemployment, and inverted yield curve where short-term bonds yield more than long-term ones. In 2022, these signs were flashing red, signaling a possible recession in 2023. Inflation was high at 6.5% and Federal Reserve's lending rate was between 4.25% and 4.5%, and the bond market showed an inverted yield curve. Despite these indicators, the recession didn't happen thanks to robust job market, rising wages, low unemployment, and strong consumer spending. However, the economy is still uncertain. Inflation is still high, hiring is slowing, and household debt has crossed $17 trillion, partly due to the high spending in a high-rate, high-inflation environment. By the end of 2023, credit card balances also grew $48 billion and marked the 8th quarter of consecutive year-over-year increases, the highest since 2011, adding to the financial strain. Looking ahead to 2024, the potential for a recession remains a topic of debate. Mortgage rates are expected to remain high, regardless of whether we face a mild recession or manage a smooth economic landing. Dr. Lisa Sturtevant suggests that even if a short, mild recession occurs in 2024, it's unlikely to significantly lower mortgage rates. Before we move on, don't forget to like, share, and subscribe to our channel for more amazing videos. How is today different from the 2008 housing market crash? Today's housing market significantly differs from the scenario during the 2008 crash, mainly due to the much stricter lending standards now in place. These changes, born from the lessons of the past crisis and new regulatory measures, mean that people who get mortgages today are less likely to default compared to those who got them before the 2008 crisis. Len Kaifa, the deputy chief economist at Freddie Mac, sheds light on the pre-Great Recession era, noting that the housing market then was driven by rapid credit expansion, increased leverage, and overly optimistic expectations for house price growth. A key element contributing to the 2008 crisis was the prevalence of adjustable rate mortgages. Unlike fixed-rate mortgages, ARMs have interest rates that change periodically after the initial fixed-rate period. Kiefer explains that many homeowners who had taken out ARMs before the 2008 crisis were caught off guard by significant payment increases when interest rates reset, leading to their inability to afford the higher monthly payments. Fast forward to today, there's another crucial difference. Most borrowers currently have fixed-rate mortgages. It highlights that even though mortgage rates have doubled recently, homeowners with fixed-rate mortgages are still waiting for a change in their monthly principal and interest payments. This stability is a stark contrast to the volatility and risk association with ARMs prevalent during the 2008 crisis. The current housing market landscape offers a key advantage compared to the 2008 housing crisis. Many homeowners today have equity in their homes, providing a buffer against potential downturns. Recent data from Atom sheds light on this, revealing that nearly 47.4% of the residential homes with mortgages in the US are classified as equity-rich. This term means the total loan balances secured by these homes are 50% or less of their property values. This situation is highly similar to late 2009, where nearly 1 in 4 US homeowners faced negative equity, meaning they owed more on their mortgages than their home's worth. However, it's not all smooth sailing. According to a CoreLogic report, borrowers experienced a 1.7% decrease in equity during Q2 of 2023 compared to previous year, translating to an average decline of $80,700 between Q1 and Q2. The National Association of Realtors (NAR) reports that the typical homeowner's net worth has increased by over $100,000 since 2019. Additionally, the national median existing home price is now about 48% higher than in January 2020. Will housing supply finally recover in 2024? The crucial question remains, can the housing market supply side rise to meet the anticipated surge in demand as we head into 2024? As we look towards 2024, the housing market dynamics are shaped by two key factors: the potential return of buyers and the ongoing challenge of housing supply. One clear sign of this issue is the slow pace of pending home sales, which are often the pace setter for future home sales activity. This is worsened by a noticeable shortage of available homes on the market, resulting in an increasingly tight housing inventory. A key reason for this tight supply is the tendency of many homeowners, particularly those who locked in very low mortgage rates during the pandemic, to stay put for longer periods. Reports indicate that the average homeowner now expects to stay home for around 15 years, a significant increase from previous trends. Another contributing factor is the demographic shift due to increased longevity. Older generations, notably the baby boomers, remain in their homes longer, unlike previous generations who might have downsized or moved to different living arrangements at a similar stage in life. Despite a boost in new home construction, more is needed to fully meet the demand. Initially, there was optimism in the first half of 2023 as builder confidence grew. However, this statement has since declined. High borrowing costs for both home builders and buyers have contributed to what is being described as the most severe housing affordability crisis in over a decade. What will happen to the housing market after a recession? With economics predicting potential challenges due to a recession, we're looking at a year when the housing market will likely undergo significant adjustments in response to these economic changes. In the face of a potential recession, 2024 is shaping up to be a challenging year, with significant implications for the housing market. Experts widely anticipate a period of adjustment for the housing sector following the economic downturn. Key to this adjustment is the expectation that as the economy slows, longer-term rates such as mortgage rates will likely decrease from their current highs. This forecasted reduction, along with deceleration in home price growth and various demographic influences, is poised to attract more prospective buyers into the housing market over the next few years. The return of buyers to the housing market is expected to vary, largely depending on how much mortgage rates decrease and the severity of the potential recession. The upcoming trends in home buying are expected to be diverse and dynamic, touching every corner of society. We're looking at a housing market that's anticipated to attract a broad mix of age groups and income levels, a reflection of varied demographic influences. What should home buyers do? So what should home buyers do in these challenging times? To put this into perspective, by the end of October 2023, the monthly mortgage payment for the median-priced home had surged to about $2,270, nearly double the $1,030 required 3 years prior. This dramatic shift highlights the increasing financial burden on buyers. A notable trend in the housing market is the rising in demand that often follows a drop in mortgage rates. Should these rates decrease significantly, it could lead to a surge in home buying interest. However, given the already strained housing inventory, such a surge could paradoxically drive higher prices, making home ownership even more elusive, especially for first-time buyers. Given these conditions, those in the market to buy a home are now exploring unconventional paths. Some are looking beyond major urban centers to more affordable locals. Others are considering stretching their financial limits or reassessing their expectations in terms of house size or amenities. Despite the challenging environment, the market is reportedly less competitive now than it was earlier. This shift offers a potential advantage for buyers, who may now face less competition and even have the chance to purchase properties below the asking price. This presents a unique window of opportunity for those ready to understand the current market dynamics. That wraps up our discussion for today. We'd love to hear your thoughts on this. What do you think the 2024 housing market will look like? Will the supply challenges ease, or will the potential buyer increase worsen the issue? Let us know in the comments.